Hey landlords and blessed investors, I'm Nicole Purvy from Better Than Success, and here's the real estate news that you need to know for the week of Monday, April 17th. Calmer inflation means lower mortgage rates. According to Realtor.com, the U.S. economy is still dealing with high inflation, but the housing sector is showing signs of cooling off. The Consumer Price Index rose 0.1% in March from the previous month, according to last week's report from the federal government. It was the smallest uptick in 3 months, and it was lower than usual due to an easing in energy costs. The yearly rate of inflation slowed to 5% from 6% and touched the lowest level since May 2021. Economists says the latest CPI data indicated a slowdown in housing inflation, which ultimately will benefit homebuyers. Shelter continues to be the biggest driver for the monthly increase. Shelter costs rose 0.6% from the previous month, slightly lower than an increase of 0.8% in February. The index for rent and owner's equivalent rent rose 0.5% in March. Calmer inflation means lower mortgage rates eventually, says the chief economist at National Association of Realtors. He also noted that inflation has slowed over the last year, which is progress, and that the ideal inflation of 2% is still maybe a year away. This directional improvement is a clear signal to the Fed to change its tightening monetary policy, especially considering that many regional banks are still on the edge of further interest rate risk blowup. Here are some other important notes from that last CPI report. Rents were up 8.8% from a year ago, but only rose 0.5% on the month compared to a range of 0.7 to 0.9% monthly gain over the previous months in the past year. Private data sources such as Apartment show that the rent index is only up 2.6% year over year versus the federal government's estimate of 8.8%. The indexes capture different aspects of the rental market, but Apartment index is ahead of the government's measure by 4 quarters, according to the Cleveland Fed. Landlords pumped billions into apartment buildings during the pandemic. That bet could now go horribly wrong. According to Business Insider via MSN, as we all know, the shift towards remote work has caused a major transformation in the way offices operate. However, apartment buildings have remained in high demand from tenants despite these changes. Unfortunately, this demand has created a bit of a dilemma for investors who pay top dollar for apartment buildings that rely heavily on rent increases and low interest rates to generate profits. In the past couple of years, the multifamily market has been incredibly competitive, and apartment building acquisitions have reached unprecedented highs, with investors purchasing a staggering $355.5 billion and $299.2 billion worth of properties in 2021 and 2022, respectively. These high stakes have resulted in investors making bold predictions about rent growth and expense management just to win a deal. The article quotes a multifamily investment sales broker. To win a deal in that hyper-competitive market, investors need to make ambitious predictions on how they could grow rents and control expenses. What they found is that rents have plateaued or even come down in some markets, and expenses have skyrocketed. The situation could worsen as more mortgages expire at properties where fix and flip strategies have failed, leading to a growing number of defaults. All in all, this is a challenging time for investors in the apartment building market. Home builder sentiment rises in April as builders grab near record share of the market. According to CNBC.com, builder sentiment in the market for newly built homes rose in April for the 4th straight month as the supply of existing homes for sale remains scarce. The National Association of Home Builders / Wells Fargo Housing Market Index climbed to 45 in April, a 1-point gain. Anything below 50 is considered negative. The reading is the highest since September. The index stood at 77 in April 2022. Builders in the report cited a lack of listings on the resale market, which gave them an unusually strong edge. New listings of existing homes have fallen about 25% compared to a year ago. Slightly lower mortgage rates are also helping demand, though rates are still higher than they were a year ago. Builders note that additional declines in mortgage rates to below 6% will price in further demand for housing. Nonetheless, the industry continues to be plagued by building material issues, including lack of access to electrical transformer equipment. The index has 3 components. 1. Current sales conditions, which rose 2 points to 51. 2. Sales expectations in the next 6 months, which increased 3 points to 50. By the way, this marked the first time both of the indicators were positive since June, when mortgage rates skyrocketed. And 3, buyer traffic, which was unchanged at 31. It was the first time that it hasn't improved this year. Builders said 1/3 of housing inventory is new construction compared with historical norms of around 10%. Concerns had grown that builders might have more trouble with construction loans after regional bank failures. But the bevy of new construction suggests that this is not the case. While loan conditions are tight, there is not a significant evidence thus far that pressure on the regional bank system has made this lending environment for builders and land developers worse. Regionally, on a 3-month moving average, builder sentiment in the Northeast rose 4 points to 46. In the Midwest, it rose 2 points to 37. In the South, it increased 4 points to 49. In the West, it rose 4 points to 38. Fannie Mae, Freddie Mac keeping secret blacklist of properties. Condo buyers and owners looking to refinance pay more for mortgages on properties that make the list. According to TheRealDeal.com, a number of properties are finding themselves on a secret Fannie Freddie blacklist as the lending firms have changed their criteria following the collapse of the Surfside, Florida condo building in 2021. Properties that haven't kept up with maintenance or aren't on firm financial footing have been put on a confidential list that only lenders and servicers have access to, according to the outlet. That's caught some would-be condo buyers and those looking to refinance their mortgages by surprise. It's a crapshoot. The only way for you to find out if a condo is on a list is if you apply for a mortgage and the lender runs that project to see if it's unavailable. And only then, typically, is the buyer informed. The list, which stands at about 1,400 properties, is also growing, leaving some buyers or owners looking to refinance having to pay more in interest to get mortgages if they can get them at all. Proposed FHA guidance for homes with ADUs. According to Reverse Mortgage Daily, the Federal Housing Administration, or the FHA, released a draft mortgagee letter on Thursday to include accessory dwelling units, or ADUs, income in the consideration of FHA financing. The proposal would require updates to FHA's appraisal protocols and underwriting requirements. With the proposed policy, prospective borrowers financing a property with an ADU will be able to use the actual or projected rental income from the ADU to help meet FHA income guidelines. Specifically, this draft proposes policy on underwriting rental income from an ADU for the analysis and reporting of ADU market rent and FHA appraisals.